My name is Eric, Chief Strategy Officer at Link REIT. For those who don't know me in the room, I don't think there's any. Welcome again to our first Investor Day in Shenzhen, the first time we combine both the buy side and the sell side in our kind of a pre-blackout briefing for the market, but also a good opportunity to later on showcase the assets which we just bought barely 2 weeks ago, Central Walk, which is next door to this hotel. And we're very pleased today, obviously, to have all members of the C-suite, CEO, CFO, COO, and myself, and also the two asset managers of our China and Hong Kong portfolio, and also Kelvin, who just arrived from Hong Kong because he just closed a conference that we were hosting this morning at the Hyatt in Tsim Sha Tsui, where we invited 50 guests to share our thoughts on sustainability. In this year's conference, which Kelvin hosted, the topic was eliminating the use of single-use plastic. So we had tenants, suppliers, government officials, NGOs together in one room this morning. More of that, please talk to Kelvin about it. And as you can see, the topics we cover today are quite far-ranging. I shall proceed. Link today. Just a very quick overview of Link. Obviously, we are still, last I checked, the largest REIT in Hong Kong and the largest REIT in Asia and the second largest retail REIT in the world, and only internally managed REIT in Asia. 100% free float held by institution and individuals. And to date, we have 126 assets in Hong Kong after various rounds of disposal, and which amounts to about 8 million square feet. Still about 56,000 car parking spaces, and we still have the quayside, the development currently underway in Kowloon East. As in China, given the recent acquisitions, we now have 5 assets across all 4 first-tier cities, totaling about 5 million square feet. Of course, our revenue, NPI, valuation, and distribution per unit need no further explanation, as you can see the growth pattern over the last 5 years. We have been presenting this value creation model where we articulate how we, through managing car parks, office, and retail, in enhancing them, managing them, acquiring them, developing one, and also divesting some of them. Through these few initiatives, we try to build a productive portfolio, maintain a balanced capital structure, develop a strong team, as well as helping our communities flourish, and thereby hoping we create share value together. As I mentioned earlier, we surpassed some of our peers. We are not yet #1 ranked retail REIT in the world. Well, hopefully getting there soon. As you know, we have been growing our total return. This is what we, management and the board, endeavor to do, which consists of both DPU and unit price. Admittedly, unit price is kind of beyond our control. Of course, it's subject to many, many market forces, some of them more conducive more recently than others. But of course, the only thing that really is within our control is the DPU, which we try to grow through these various measures, as I mentioned. Since IPO, we have been doing asset management and enhancement actively. Since 2011, we've been doing acquisitions in Hong Kong and then subsequently moving along to China. Disposal since 2014. So far, we've disposed 57 assets. And property development, 1 asset in Hong Kong, as I mentioned. Property redevelopment is something that we have in mind, but not yet, hopefully, sometime in the future horizon. This is a very quick summary of Link, and well, because me and the investor relations team obviously have been fielding questions from a lot of you over the years, and these are pretty much the few key questions we see coming from the market. how sustainable is the organic portfolio? That will be answered by Emmanuel. How do we see the mainland China market? That will be answered by Gary, the two asset managers responsible for Hong Kong and China. And how do we plan to grow our portfolio? That will be answered by Andy, our COO. And our capital management priorities, obviously that falls under CFO KS. And then is Link a responsible investor, which is a question we're getting more and more these days. And that will be answered by Calvin. And then finally, how do we see Link in 5 years and perhaps beyond? And that obviously falls to George later. And after that, we will have a Q&A session, a short break, and then we will move on to our site visit Central Walk nearby. And without further ado, I shall welcome, before I welcome Emmanuel, I think I would definitely want to take this opportunity to give a round of applause to the tireless and ever diligent investor relations team led by Luna, and with Carol and also Fanny. The three of them made this happen today, and thank you very much for that. And without further ado, Emmanuel, please.
Thank you for our management's presentation, and we are now open up the floor for Q&As, and please let us know, please raise up your hand and let us know the company that you're representing and also your name, please. And please. Leon from Cohen. I introduced you already.
Thanks for the presentation. I noticed one of the earlier slides you had redevelopment as one of your growth drivers. Can you elaborate a bit on what the opportunities are available on that front, given your portfolio is not as straightforward as some of the other property companies you got? Some of them maybe you got obviously a background with the government. Some of the assets are attached to the public estates. You also have corporate components. How difficult or easy it is to redevelop your assets, and it would be great if you can share some of your thoughts on that. Thanks.
That's why the chart actually say future and probably distant future. It will need a lot of maneuvering. There are opportunities, I think, but probably much longer term. I think that we just want, for completeness sake, we decided to put that in as part of that growth driver, but it's not something that we see in the near future.
So sorry, follow up to that. If you are to develop your assets, your assets in Hong Kong, a technical point, does it require government or legal approval to do that, or are these assets are now considered, privately owned, like same as Sun Hung Kai assets, where you can do it whenever you want?
I don't think they can do whatever they want to. So basically, the easiest way to look at it is that the way that we own a share in the estate is no different from you own an apartment in a building. So we are co-owner of that estate, and together we also own the area within the buildings that we currently own and operate. So we need to work with our co-owner. Within the boxes that we have, we can torn down those boxes and rebuild as long as it is of the same dimension externally. But we can't make it taller, we can't make it narrower, unless we work with our co-owner to work out what are the changes in GFA, site coverage, heights, and all that. So if we can jointly redevelop some older estates, that will be an ideal situation. In the short term, we're doing a lot of asset enhancement. Some of them are more drastic than others, and hopefully that is enough to last us for a fair bit of time. the way you look at it is, as we present sometimes, is the year when it was built, but also the most recent year when we have finished the asset enhancement. We basically have made that part of the building younger already, and so it should be able to last a little bit longer.
Sorry, one more question. You also mentioned one of your slides about AUM, right? So what are your thoughts on managing other third-party assets or assets which I understand some of the assets are, which you don't have a 100% stake, but what are your thoughts about managing other third-party assets and maybe charge an asset management fee and so forth? Is that a potential growth model going forward?
We don't see that as something that we want to do in the near term. Part of the reason is we have balance sheet capability to invest ourselves. So to be a GP, you do that because you want to use other people's money. I think we have enough money ourselves. But the other way to look at it is we only own 60% of the Quayside, and we do charge the JV fees for property management and leasing, and that's one way of leveraging. So in the future there may be projects where we don't own 100%, but more because there are reasons for either funding or in the Quayside leveraging on Nanfeng's development capability, but not so much becoming a fund manager.
Thank you. Question for KS. On slide 57, you'd mentioned unit buybacks, special divvies. What is the intention there? And if you could also sort of touch on the payout ratio as well as part of that.
Sorry, can you repeat the last few sentences?
So the payout ratio on a go-forward basis, obviously the payout ratio has been relatively elevated of late, but on that slide you've also got special dividends mentioned. Obviously the buyback has been in place. If you could just talk broadly around.
So I think this has been one of Luna's hot questions on where are we since we spoke to you. I guess it's June last year when we said that we still have 80 million units to buy back from the disposal done in FY 17-18. I think publicly you could calculate that we still have a remaining about half of that number that has not been bought back. I think the holding statement is that we are committed to continue to buy back, and in the scheme of capital return and stewardship, we prefer buyback, and only if necessary then we will look at special distribution. So I think we'll put it here. That's all that we are able to discuss now. Anything else, I guess we have to go through committees and board to decide how things will pan out in terms of the whole capital return strategy.
Sorry, just on the payout ratio, versus be it FFO, EPS, AFFO, how do you think about where to set the dividend?
So the payout ratio so far has been above 100% because of the depreciation from China. Since the last AGM, I think we are able to now agree in that under the mandate that we are going to put the depreciation of China into the payout. So it will be able to get to 100 by mandate. So if we were to do anything more, then it will definitely go beyond that. And that's something that we are able to do if that's what the board and management choose to do.
I'll add to that. You have built in your model an assumption of how much we're going to buy back, which reduce the denominator. We have not been able to do that in the market. The blackout is coming in a few days' time. Given the amount of buyback that we wanted to do, to deliver a certain DPU, we believe that we will still deliver that DPU despite not being able to do the buyback.
Damon from LaSalle.
Thank you for the presentation. I noticed in the presentation there are some more details about future acquisitions. For example, you mentioned the greater area regarding surrounding the 4 Tier 1 cities in the PRC. You also mentioned that you remain opportunistic in other regions. I just wonder whether you can share a little bit more details regarding what are the second-tier cities that you're looking at, apart from the first tier, and also what other regions are being considered right now? Thank you.
I think, like we mentioned earlier, we are still sticking with the Tier 1 cities, but we have been spending time to look at the surrounding areas. For example, if you talk about not exactly going all the way to Tier 2 city, if you look at the Shanghai area, we are spending a bit of time looking at Hangzhou, Suzhou, things like that. So it will be more like a Tier 1.5 cities. But not that we are going to invest there, but we are going to still apply what we have presented earlier, how we are going to select our assets through connectivity, good locations, and about the catchment area.
We will continue to learn about what are available. We have not we do not have any particular country or city that we target. But you'll hear about us traveling to different places to learn about what's available. I think if you use the same criteria against these possible locations that we might go to, we at least find it very difficult to find any assets. So we'll continue to have that discipline, but there's no particular place where we actually say we want to go there, apart from the 5 cities that we have already talked about.
Maybe a follow-up question to that. So instead of buying real assets which are low yielding, like this Central Walk is like low 3% entry cap, there are a lot of listed retail rates in other markets that are trading at a substantially higher implied cap rate. What's our thought on that in terms of taking some of those private?
Let me address it in 2 parts. The first part is in some ways repeating what I said just now. And one of the criteria is long-term growth potential. We don't mind being competitive in acquisition and paying sometimes what might seem to be an aggressive price if we believe that the growth rate is significant, the reversion rate is significant. We've just taken over the asset next door. I think at least one of the lease, not going to talk about which, but it's already have a reversion rate of 3-digit. Right? And so we saw that in our underwriting. We executed within the last 2 weeks. So if we can achieve high growth, we don't mind being a bit aggressive. The second question, remind me. Oh, sorry. The other, well, is high growth, maybe a bit aggressive in pricing versus if you go to some cities where you get higher yield but slow growth. Are the others buying companies? I can't beat you in judging management teams. You are a better judge. You've been doing this all the time. I'm not. And so if you can judge which are the companies to invest in, and sometimes you win, sometimes you don't. We focus on real estate. So judging company means 2 layers. You have to like the real estate that they own and like the management team. We are probably too simple to do 2 things at the same time. So we want to focus on just the real estate.
Ken from Citi.
Hi, it's Ken, Citi. 2 questions. First question is regarding, I just want to check, does management have any concern with your stock trading liquidity? Because that may affect your share buyback strategy, which recently in your green bond issuance, convertible bond issuance, one of the reasons for you why you issue the bond in the statement stating that potentially that can improve the liquidity if there is a conversion. Does it mean that you have concern on liquidity, trading liquidity now? So another question is basically in your 5-year strategy, you focus a lot of the growth. So this also linked to your buyback because a lot of the traditional company thinking buyback is basically make the company balance sheet is smaller. So it is against the growth concept. So basically, if you talk so many on growth, does it mean that you don't like buyback?
You want to do the first?
I think in the context of the CB circular that went out, I think one of the risk factors stated there is that there's a risk of liquidity. I think the context was that if it should be converted, right, then of course we get about 1.7% more shares vis-a-vis the current outstanding pool. That's in that context. I think it's pretty boilerplate for most CB circulars.
Well, the CB does open us to a new channel of financing, so not so much because of the liquidity concern. The building of the AUM, you can look at it in many different ways because we show you a chart focused on AUM. We didn't show you a chart focused on asset per unit, distribution per unit. Those are things that we will work out. But if you base on a very simple assumption that as we grow the portfolio size, we will be able to deliver a higher distributable amount, then it's a question for KS and the team, what is the denominator? Those are things that we have to balance, and whether we finance by debt versus equity and all that. But on one side of the balance sheet, I think we've given you some idea where we go.
Daniel from Timber Creek.
Yeah, thank you very much for giving us the opportunity to be here today. I have 2 questions. The first one would as well target the acquisition and growth strategy going forward. Here, given the entry cap rates we have seen here for the most recent transaction, how do we view further developments going forward after the completion of the quayside? And how should we actually see developments with partners or standalone in the mainland versus Hong Kong, where we may have even more attractive yield on developments compared to buying into cap rates for stabilized assets?
We want to deliver a sustainable, growing total return. So it really depends on how you look at us, and we know that there are different investors in the world. Some focus more on income, and some focus on total return. And that is actually, the distinction is very important. Because if we focus on buying certain assets where there is maybe a longer or steeper J-curve, it's different from buying assets where it is immediately yielding. And we believe that while we can execute very well and deliver that path, we are very careful, just as when we were planning the asset enhancement program, we don't want too many steep J-curve overlapping at the same time. Otherwise, the growth of our distribution will slow in certain years. Having said that, we do have that little bit of a dip, perhaps looking at the next financial year. Quayside, the tenants are only moving in later part of the year. TOP just completed. And so there are some times when we need to manage that and see how we can offset it by, for example, slightly stronger growth in Hong Kong by planning the asset enhancement a little bit better. So we do a 10-year model, trying to make sure that we plan those as well as we can. But we do have to deal with market conditions, retail market being buoyant or slow down depending on economic situation. We now have 6 different property cycle to play with. Right? Retail in different cities and 2 cities where we have office. So hopefully with all that diversification, it helps us to balance out a little bit. And also our portfolio are growing at different time. I think we are challenged to do more development, not because of the 10% limit, but because it does take a long time before we actually get strong cash flow. Even if we filled up some of these early projects, it's a little bit like a big asset enhancement. Sometimes the first cycle we may not get the best rent. We might wait a little bit longer. Development with a few more years of digging the hole and building it takes even longer. So we want to balance it. But having said that, as I mentioned, it's total return. So if we sell Quayside tomorrow, it's going to be worth a fair bit of money. But if we don't, then yield on cost, cash flow may not be as high. And so how do we balance that depending on your investment strategy, how you look at us? If you add up both the distribution and the capital value, then it makes more sense, I think. And our portfolio will continue to move further towards that, which is very different from how you look at us a couple years ago, where it's totally based on cash flow being distributed.
Yeah, thank you very much for this. Just one add-on question here. This is rather technical, and I would like to know about the China REIT situation. Obviously, we're kind of in the finalizing stage to get on a China REIT alliance. How would Link REIT profit if there would be a China REIT structure? Due to the structure we have currently set up from a tax point of view, would there be any savings in tax purposes to repatriate money back to Hong Kong in case we have a China REIT? And then the second part of question would be, are you active lobbying for a China REIT, and what would be your involvement here?
Okay, we are set up as an internally managed REIT, so we don't really think about managing more funds and set up more funds and another REIT to manage. Having said that, because there's no REITs listed on Shanghai and Shenzhen Stock Exchange, we do not participate in Stock Connect right now. As soon as there is REITs listed in China, then we will participate as part of Stock Connect. And so you can see demand from China, fund managers and investors coming to invest in us through Connect in the future once that is set up. So I think that's probably something that is significant. When that happens, I don't know. But we're not looking at set up a C-REIT ourselves.
Jeff from DBS.
I have 2 questions. The first question is related to the unit buyback. As far as I remember, when you announced to buy back 80 million units back to June, it's related to the DPU dilution arising from the disposal of 17 assets back to more than a year ago. But at the same time, I still remember a few months ago, you make this second disposal, which is related to 12 assets in Hong Kong. Should we expect any unit buyback relating to this disposal, or the proceeds should be largely used up for the acquisition in Beijing and Shenzhen, so there should not be any unit buyback? The second question is related to CB. When you discussed to return the capital to the unit holder through unit buyback or special dividend, but at the same time you raise the capital from issuing CB, it seems to be in a opposite direction. Does it mean that the ultimate reason or rationale behind the CB issue is the cost of funding using the CB is very attractive, so that you choose the option just a few weeks ago?
I'll let KS answer the first question later. The second one is rather easy. Even if we buy it in the market today at $90 a unit, the CB conversion is over 109. That's a very straightforward saving in terms of raising equity. And if we don't get to that conversion price, then we are funding it at 1.6. So either way you look at it, I think we're getting either cheap debt or cheap equity when we price it. So that has no conflict with buyback. We are selling some equity at a very high price. Yes,
so you are right. The buyback currently that we have been talking about pertains to the 1718. And the 1819 proceeds that we have received has also been progressively used to be reinvested. That said, I think there's intention to put some of the proceeds to repayment, subject to board again on how do we reward unit holders that have been with us through this process, or return what we deem is yours. How we split that, we have to wait. But I think all the three options are being put to use at this point.
Thank you, management, for hosting this event. I would actually just like to hear a bit more about the opportunities that you see from the Greater Bay Area, actually in particular how it might benefit your existing Hong Kong assets, maybe more color and kind of how to think about the sustainability of your past 20% plus rental reversion that you have obtained for the Hong Kong assets. Thank you.
Thank you, Leonie. We, as Emmanuel articulated earlier, there was with Hong Kong being fundamentally quite sound and stable first, but we're also utilizing, for instance, technology with our app and opening WeChat channel, and in the Chinese New Year, how that actually helped, not for all assets, but selectively, say Temple Mall in Wong Tai Sin, how that managed to bring in some traffic to Wong Tai Sin using WeChat. Another means of attracting was how Asset Management China and Asset Management Hong Kong, the two marketing teams actually worked together to forge stronger ties. We have got KOLs from China to go to TOP in Mong Kok. We've got KOLs in China to go to Temple Mall in Kowloon, and thereby promoting the brand, promoting the asset in China, and try to pull shoppers who go to Metropolitan Plaza in Guangzhou and potentially Central Walk in Shenzhen and pull them to Hong Kong as well. So, so there are quite a number of efforts being put in there. Honestly, a bit too preliminary to see exactly, how, that will materialize, but this is something that we're certainly moving forward with and will explore and enlarge going forward. So just talking roughly about the marketing aspect. But other things that we are learning actually is how to more effectively use WeChat. In fact, I think the Hong Kong team is actually learning a lot more in that regard from the various China teams. Of course, the various China teams are learning a lot from Hong Kong as well in terms of property management standards and how we can better launch our marketing programs, our weekend activities, and so on and so forth. So it is really a two-way mutual enhancement of standards and efforts done in marketing and whatnot. So in particular for Greater Bay Area, because the proximity, number one, obviously, the more, identity with the culture, there is actually a lot of sharing. Remember there was earlier a slide showing how in the 4 assets we own in China, how there were all these common tenants. In fact, there were, what we didn't show, I was thinking about showing, was common tenants between, say, our Shenzhen Mall and Guangzhou Mall with our Hong Kong tenants. There's actually quite a lot of them as well, in particular in F&B, because of really very similar tastes and culture and habits that we within this area enjoy. And that actually has spurred more discussion with some of our top tenants as well, in particular
some of the, actually after we bought Metropolitan Plaza, Gary very quickly talked to our Hong Kong leasing team, and we've actually introduced some of our tenants with relationship with us in Hong Kong. Some of those leasing manager who are responsible for Guangdong are actually based in Hong Kong, or they have this Great Pearl River Delta remit, and so that has helped us. We've applied for a cross-border bus now set up, from Metropolitan Plaza to Temple Mall, so you can buy tickets at both sides and get on this cross-border bus. The promotion in Chinese New Year, shake and find get the Lycée. We have 11.5 million people using it watching that promotion. 40,000 people actually get the Lycée distributed. And what I thought interesting is that with WeChat you can actually find out where these people come from. 80% from mainland, 20% from Hong Kong. But out of that 220,000 people from China, we even have people all the way from 12,000 from Hebei, 15,000 from Jiangsu, 12% from Hunan, and then 45,000 from Guangdong. So we can now start to study in more detail about how the connection is helping us, how the high-speed rail, bridge, and all that's affecting us. But it's early days. We'll share more as we get deeper into it.
In the interest of time, maybe we'll have the last 2 questions from the floor. Hildy from Morgan Stanley.
Hi, management. This is Hildy from Morgan Stanley. 2 questions from me. One is a bit short term. It's about what do you think about the asset disposal pipeline? Assuming no more acquisition, should we still consider more disposal given the capital recycling and the taking opportunity of the still low cap rate environment? The second is about more longer term. Can you give us some more color? How do you think about the competition landscape in China and Hong Kong from e-commerce? Because we see that e-commerce is definitely very popular in China, and we are seeing growing popularity for food and fresh market, fresh food delivery here. And in Hong Kong, it seems growing. We see more e-wallet nowadays, and seemingly younger generations are more e-commerce friendly, and while the public housing residents somehow sometime later will become younger and more internet friendly. So what do you think about it? Thank you.
I think Gary can answer about China a lot more, but what we found is that Hong Kong and China for F&B is actually very different, especially the food delivery and fresh food and all that. And there's a lot more here. But in Hong Kong, fresh food online purchase is still more sort of middle class, smaller in number compared to here, where it's more mass market as well.
I supplement that. In fact, we don't see the e-commerce is a threat. We do see it's a complementary service to each other. We do see a lot of online, offline operation, especially for the food delivery. Nowadays, the restaurant in our mall, they are not only doing the business with the customer come to our mall, they do with other business with delivery. So we do see the increase in the total sales of the shop, but we capture the turnaround if they do much better business.
I think the only thing we don't like about food delivery is not, we capture the turnover, so we don't mind about that. It's just that the delivery person is not going to have an impulse buying and shop at the jewelry shop and buy someone a ring, but hopefully not. But unless they otherwise, we don't have that additional business. On disposal, we don't have anything planned. Our gearing is very low. There's a lot of capacity. Our borrowing costs at a very low rate right now. There's nothing immediate. So no particular intention in the near term.
The last question coming from Justin from Goldman.
Thanks, Justin from Goldman. Perhaps two questions. One, I just want to understand a bit of the thinking process behind the medium, like 2025 target. Why it's more attached to the AUM rather than DPU as a broader focus. And the other one is actually a reverse of what Hildy just asked. In a way, is when you look at the list of your projects, and then when I listen to the presentation on the asset management side, you look at the AEIs that you put out on the bar chart, what you're running now is around 100 to 150 million per project in terms of AEI spending. And then the futures that you are planning now is down to like 40 million. So are we at the end of the kind of AEI cycle, and when would you decide what kind of metrics are you looking at when you decide whether or not to sell them? Thank you.
I'll answer the AUM question. I'll let Andy talk about asset enhancement. I don't think we can talk about profit forecasts. We can't talk about income statement numbers. So if we give you an AUM number, hopefully you can just do your own projection. So I think that's as much as we can say, right?
Indeed, if you just purely look at the numbers in the last few years compared to a few years back, some of the AEs are getting smaller. But the thinking behind, we always have to not just think about the size of the AE, we also have to look at the income profile. So one of the key things we do when we plan our asset enhancement is we try to maintain a very stable income coming in, and don't want to have a big AE in a certain period that will have a big dip in the income stream. So that being said, the beauty of running retail asset is, if you look at our pipeline right now is 10 years ago we have revamped Lok Fu. 6 years ago we completed the market AE. And if you look at the recent two presentation slide in our result announcement, we are also going back to a Lok Fu and doing the Zone B and Zone A project, which, if I remember correctly, the numbers, if you add that two together, the project cost is still probably around $300 million. So that is still a very sizable AE, even after 10 years when we first done it.
Yeah, just to share a little bit more, I mean, Lok Fu, Zone B, if you go there now, the glass box at Junction Road is open, tenants moving in. Zone A work will start later this year. We have finished negotiation with Henderson Land, which now owns Uni. about the remodeling of that the 2 floors, and then we still have Kaitin, which we haven't done yet, which is amongst our top 10. So we still have a few large assets that we will need to do. And the other reason when you look at the pipeline is that some of the more, especially a couple of years ago, really need huge repositioning. That increased the capex. But there are a lot more now where I think it's more about right tenant mix, and so we'll continue to improve. You'll see tenant changes in Temple Mall, for example, but you won't see an asset enhancement program at Temple Mall. So hopefully we'll be more capital efficient as we improve.
Right. Thank you very much for your questions, and thank you, management team, for this Q&A session. So this wraps up our presentation today for our Investor Day.